Welcome everyone to today's lecture on financial management. I'm Ms. Vishah Hussain, and today we will be exploring key concepts and functions of financial management that are not only crucial for your exam but for real world application as well. So let's dive in. Introduction to financial management. First of all, we need to understand that what is financial management. We often hear this term, but we do not exactly know the meaning of this term. So, financial management plays a fundamental role in the success of any business. The primary goal is to manage the organization's wealth properly, the organization's finances properly, in order to help the organization maximize its wealth. So, there are three key elements of financial management. The first one is financial planning. Now, what is financial planning? Financial planning basically involves planning the financial future of the company. It includes budgeting, forecasting of future revenues and expenses. Next, we have is financial control. Now, what is financial control? It ensures that the company and its assets are being utilized efficiently. There's no wastage or there's minimal wastage. It involves monitoring financial activities and ensuring that plans are being followed properly. Third, we have financial decision making. So, financial decision making is where we make key decisions related to investment, related to financing, related to dividends, which we will break down in the next slide. Now, types of decisions: investment decisions, financing decisions, and dividend distribution decisions, which I told you in the last lecture that this is majorly what the whole financial management syllabus covers up. So, financial decision making is one of the most important responsibilities of a financial manager, and it involves these three major types of decisions. Investment decisions, first of all. These decisions are going to revolve around where and how to allocate the capital. Should the company invest in new projects? Should the company purchase new machinery? Should the company acquire another company or not? Secondly, financing decisions are going to consider how the company will fund its investments. Now, for example, you have planned on investing into a new project. Where will the finance for that new project come from? This is something that comes under financing decision. Should we raise capital through equity? Should we raise capital through debt? Should we raise capital through internal profits, which are also called retained earnings? Third type of decision is dividend distribution. Now, in dividend distribution, once profits are made, how much should be retained for future investments? Should all of it be distributed to shareholders, which definitely is not the best way of using your profits? So, how much should be paid as dividend and how much should be kept with the company and reinvested back into the company as retained earnings? A finance manager will need to be able to take the right decision in this case as well. Now, these decisions are interconnected because, for example, using internal profits for investment could affect the dividends paid to shareholders, and this may have an impact on investors' satisfaction as well. Moving on, we're going to look at the financial management function through the lens of strategy in this slide. You can see three strategies listed: corporate strategy, business strategy, operational strategy. Question is, what are these different types of strategies? Corporate strategy involves high-level decisions such as whether to enter a new market or launch a new product or not. Business strategy is going to include, um, for example, you have individual business units that exist within your company, and you need to prepare a strategy that how can each of those individual business units compete effectively, how can they earn efficiency, what kind of efficiency they need to achieve operational efficiencies in order to maximize profits and minimize costs or minimize wastages. So all of that will come under your business strategy only. Next you have is operational strategy. These are day-to-day decisions that focus on areas like working capital management, which is one of our chapters in finance or financial management. Next, coming back to operational strategy, like I mentioned, these focus on day-to-day expenses. These focus on day-to-day decision making, making sure that the company has enough liquidity to meet its short-term obligations. Each of these strategies build upon the other, with operational strategies supporting the business strategy, and the business strategy will then support the corporate strategy. Now, financial objectives of companies. You know that every company must align its financial objectives with the need of its stakeholders. I'm not saying shareholders, I'm saying stakeholders. Why stakeholders? Because shareholders are just those people who own your company, who are part owners of your company. But stakeholders will be all those people who are affected by the decision making of your company, right? Which is why stakeholder groups are way more than shareholders. Shareholders are one of the stakeholders, yes, but not all stakeholders are also shareholders. I hope that makes sense. Moving on, internal stakeholders are going to include employees and managers who are directly involved in the day-to-day operations of the company. Next we have is connected stakeholders. This group includes equity investors, finance providers, community, customers, and suppliers. External stakeholders include the government, which is interested in making sure that you're complying with the rules and regulations. So they're interested in checking regulatory compliance and also tax collections. As a company and as an entrepreneur, the company's owners should be able to balance these stakeholders' objectives, because without that, the company's financial health may not be maximized. Moving on, we have agency theory. You may have heard this agency theory in probably O levels or A levels if you've studied business. Or if you have previously studied accounting, you may have heard about agency theory. And some people may not have heard about agency theory, so I'll provide a complete description of it. Agency theory addresses the conflict that arises between principals. Who are the principals? The shareholders. And agents. Who are the agents? The directors. The key problem is that directors might prioritize their own interest over the shareholders' interest, which creates this agency theory and which also creates a conflict between the shareholders and their agents, that are the directors. Common issues include high remuneration for directors, or often at times directors may want high remuneration for themselves. They may get involved with creative accounting to make the company appear more successful than it is, so that the shareholders see that, okay, the directors did their work and they actually get a higher pay. When in reality, probably the company was making low profits. Also, avoiding takeover bids that may be in the best interest of shareholders, just because they are not in the best interest of the directors. What is the solution for this? To solve these issues, we have corporate governance measures and fair reward packages that align the interest of directors with those of the shareholders. This makes us question that what is corporate governance? You may have read this in your audit and assurance paper that was previously F8. So you may have heard this term. Good corporate governance ensures there's transparency and there's fairness. So the key elements include a strong presence of independent, non-executive directors who can provide unbiased oversight, separate roles for the chairman and CEO to avoid conflicts of interest, remuneration and nomination committees that ensure fair compensation for executives, and transparent recruitment processes. So these codes promote trust among shareholders and ensure that management acts in the company's best interests.